Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about a stock that could literally 10x in 2022. And without further ado, I just want to get straight into this video. But if you want more videos like this one, remember to go and smash the like button right now, subscribe if you are new, comment your favorite stocks down below or stocks you want me to report more on, and without further ado, let's get right into the video. So it's not that simple turning $100 into $1,000 or even $1,000 into $10,000, but there are stocks out there that do provide us a good investing opportunity to 10x our money. However, typically this would involve some very speculative high-risk investments, and this particular stock will be no different. The potential for dramatic gains are normally always risky, especially in the stock market. But taking on this risk is necessary to 10x our money in such a short amount of time. And the best way that I have found to do this is either with a new company that is IPOing for their initial public offering, or they are going through a SPAC, which stands for a special purpose acquisition company. Normally, these blank check companies are listed on the stock market for around $10 a share, and they are used to take another company public so it can be traded on the open stock market. So what we need to do is find a SPAC that can more than 10x to $100. So what we would need to do is we would need to identify a company that, when it fully merges with this blank check company and it goes to the public market through this SPAC merger, we need it to go all the way up to $100. And we have identified a company right here. But first, I'm going to start off with the SPAC company. The ticker name is going to be EJFA. It's down here on screen, and it's called EJF Acquisition. And they are taking a very important fintech company public in early 2022. So let's discuss if this SPAC in this company can 10x our money in the span of just 1 year. So the company is named Pagaya, and in many ways it's very similar to Upstart Holdings. And if you don't know what Upstart is, don't worry, we will go over what Pagaya does. Currently, if you are curious, Upstart trades for around $96 per share, and they have a high-end price target of $350 per share. And since Pagaya is in that same industry, in that same market sector, we could see similar growth and very positive investor sentiment regarding this stock. Pagaya is a very innovative fintech company that focuses on their lending platform that uses artificial intelligence to help banks and other loaning institutions assess borrowers. With this technology, institutions can assess whether or not borrowers are high risk or low risk, and this will also allow them to issue more loans, thus bringing them in more revenue. Pagaya has been privately held and was founded back in 2016 in Tel Aviv, and now it has offices in New York and Los Angeles. They also have a great networking partnership with many banks and other fintech companies, which just solidifies Pagaya in this particular marketplace. The company is also expanding and offering new products every single year. It has offered at least one new product annually since 2018. It started off with just regular loans, and then they added auto loans, and then they added credit cards, and this year they added real estate to their product portfolio. They also plan to enter other very lucrative markets, such as offering mortgages and even insurance, so I am very excited for that, and overall I am just excited for fintech as a whole. Pagaya currently has around 170 researchers and data scientists that look at data for accuracy so they can lower the risk of various loan approvals that they give out to people. Pagaya has formulated a much better system through their AI technology than the regular FICO score system, because if you have credit, you most likely have a credit score, and that comes from the FICO system. Pagaya's technology has been very useful for a plethora of other institutions because it offers a very simple API plugin, so partners of Pagaya can easily integrate their AI technology platform into their own software operations with just a click of a few buttons. This has been so successful that Pagaya has evaluated more than 17 million applications over the past year. They also have a very strong management team which has ample experience in both traditional banking and technology companies. So it's always good to see how a very innovative fintech company is being led by management that actually has experience in these various industries. The reason why this company could potentially 10x is because we are identifying this company early on, so early that they haven't even officially gone public yet because they haven't officially merged. However, the merger is set to take place in the beginning of 2022. The company is still fairly small right now, which means that it has fantastic growth potential potential to easily 10x in the future. It is much harder for larger companies to 10x because they are most likely already appropriately valued. Currently, Pagaya has brought in around $320 million worth of revenues just in the first 9 months of last year. Pagaya is still a relatively small company because they only brought in around $320 million worth of revenues for the first 9 months of 2021. However, this would represent an increase of around 220% from the full year of 2022. And just the second quarter of 2021, they experienced a revenue growth rate of around 300%. They also have $4.7 billion worth of annualized network volume, which is absolutely fantastic, and that would represent an increase of around 154% since 2019. So overall, they have had very impressive growth, and they are rapidly expanding their network volume as well as their revenues. It's also very impressive that they have had a 100% retention rate for their partners and customers that have joined them since 2018. So clearly, their technology is so valuable that they have not lost a single customer. The reason for this is because the institutions and partners that Pagaya has lended out their software and their technology to have actually seen increases for their loan approval rate by as much as 30%. So this both gives Pagaya revenue as well as that particular institution. And because their technology works so well, why would any institution want to drop them? Pagaya also has a massive addressable market because it is competing with traditional banks as well as other fintech companies. According to data from TransUnion, Pagaya currently is in a market that has a total of around $4 trillion worth of open market opportunity, which is going to evolve into an $18 trillion industry once Pagaya actually finishes expanding, because again, they still have to get into mortgages and insurance products on top of many other segments that they are going to evolve into in the future. So Pagaya's strategy is much more expansive and innovative than, say, Upstart's. Not saying that Upstart is a bad company, however, Upstart just doesn't have the initial growth potential that we need from the SPAC investment that Pagaya has. Pagaya also has the goal and objective to create a full credit analysis ecosystem for underwriting for all industries that deal with either money borrowing or money investments. And this is a fantastic goal to have, and it also tells investors that they have big dreams and they plan to scale up to these various objectives. The SPAC deal is scheduled to go through in the coming months because we are already in the first quarter of 2022. The company is set to go public at around $8.5 billion, which would equate to around 12.5 times their 2022 revenue. Another reason that the author points out about how Pagaya is going to experience fantastic growth is that when Upstart initially went on the public stock market, their stock price skyrocketed at around 271% in 2021, and they think because Upstart and Pagaya are so similar that this could also happen with Pagaya. Now, I do want to point out that because this is a potential 10x company, there is plenty of risk involved here, so make sure you are properly diversified in your portfolio and make sure that you have the margins and the availability and the capital at your disposal to take on some of this risk. Because if I can draw over here in this chart, when a company goes public, normally on average either two things happen. First, when a company goes public, so it's trading flat, and then when it goes public right here, the stock price will either fall initially, which could present us with a good buying opportunity. So if Pagaya goes public and then falls and eventually finds its bottom, that's where we would want to invest into this company, because eventually, because of the good fundamentals of this company, the stock could rebound. Now, if this doesn't happen, something else may happen. So it's trading at its SPAC valuation and then it goes public right here, and then initially we will see a giant surge similar to many other IPOs that absolutely are fantastic based off of excitement. So after the SPAC deal actually goes through, we could see fantastic excitement and investor sentiment going into the stock. Sometimes this also happens before the merger officially goes through, just based on how excited investors are for this particular company. However, according to the stock market, what goes up normally always comes back down and it pulls back as the invisible hands of the market pushes the company to what it's truly valued. So please be aware of either the initial pullback that the company could go through, or after the initial hype of the company dies down, it will pull back. And once it does pull back, that is when we would want to invest. That would be the best buying opportunity. The only other really good buying opportunity that we could get is if you could time it before the investor sentiment, which means we would want to get into the stock right now. However, I find it more risky to do that because once either of these patterns start, I know that we are headed toward a bottom, so my chances of actually timing it are much better. If you are interested, there are also two other companies that I find are very undervalued right now, and that would be Roku, which supports streaming services on their hardware, and Latch. Roku currently trades at around $157 per share, but it has a high-end price target of $500 per share, so that gives investors well over 200% upside. As for Latch, the current stock price is $6, and the high-end price target is $15 according to analysts, which gives investors around 137% upside. Now, these are not as speculative as, say, Pagaya, because these are less risky, and normally the higher the risk, the higher the reward. But I want to hear your thoughts. Comment your thoughts down below. Remember to smash the like button on this video, subscribe if you are new, and I will see you in the next YT video.